It is very nice to be back again, speaking about creditor insurance again. I'm really making this a regular gig, which is a lot of fun. Just as a brief introduction, I'm a partner at KPMG. These days, I focus on M&A, predominantly in the financial services sector, but I've basically spent the last 10 years of my life working with banks, insurers, lenders, credit unions, all around helping them think through different ways that they can deliver the products and services that Canadian customers need. And over the years, I've been exposed to creditor insurance as kind of the unsung hero of helping protect Canadians and ensure that they can get access to the capital that they need while protecting themselves against the unpredictable things that can happen in their lives and in the world around them. So today, we've got an excellent panel. Two folks who are really involved in framing and delivering creditor insurance in really unique and compelling ways. So I'm going to ask Zack and Vaishali to quickly introduce themselves, and then we'll get into the conversation.
Okay. Maybe because I'm at the end, I'll go first. Hi, I'm Vaishali-Hollands. I'm with Meridian Credit Union. I'm the VP Product Operations and Support. And I've been there for 90 days, so I know so much already about that. Prior to that with EQ Bank for an amazing 2 years, and I see some of my colleagues in the crowd here. And then prior to that with Manulife, Global Wealth and Asset Management, and prior to that TD Bank. So lots of experience and totally get where credit insurance fits. And looking forward to our conversation today.
Hi everyone, I recognize many familiar faces here. A pleasure to be here. My name is Zack Fuerstenberg. I'm kind of, I guess, representing the insurance perspective on this panel. I'm at Cooperators, and I lead the financial services distribution arm of Cooperators. We're a fairly sizable multi-line insurer with 7,000 people, and that doesn't include our network of licensed agents, another 3,000 or so. We're solely focused on Canada, but we provide everything from home and auto solutions to creditor, and super excited to be here. And this is a passion project for me, so I can't wait to talk about it.
So we're hoping this will be a very interactive session. So honestly, at any point in time, if you have a question, throw your hands up and we'll get to it. Way more fun than just hearing the three of us talk to each other. So please join the dialogue. Maybe just to get started, I will say, in full disclosure, everything I know about creditor insurance, I kind of learned from Zack when we were working at Scotia. So I don't presume that everybody has a full understanding of what the products are and how they work. So maybe to start, I'd love to hear from both of you an overview of the kind of creditor insurance products your organizations are bringing to the market and how they fit into your overall strategy to build holistic customer relationships. So maybe Vaishali, I'll start with you.
So creditor insurance is really something some of you may be familiar with. You sign up for it at the time when you get your mortgage or line of credit, or maybe even on your credit card. And what it does is that in an unforeseen event, if it's life, disability, critical illness, or in some cases job loss, that creditor insurance comes in and basically pays off the debt. And so from a value perspective, from a member perspective, it's great for those situations where maybe somebody is underinsured or just needs that insurance to kind of cover off the mortgage piece for those circumstances. It does have a complementary value to life insurance as well, and we can talk about that separately, but that's how it fits and that's how it works, and that's how we promote it to our members, although it's their choice whether or not they get it in terms of being able to cover that off for their families.
Yeah, fantastic. If you think about it, there's a lot of dialogue today around this concept of embedded insurance, which, embedding insurance into customer journeys or digital or ecosystems. But if you really think about it, creditor insurance, which started in Canada in kind of the 1950s, is really the original embedded insurance model. So, in that moment of need when somebody's, borrowing, there's a very kind of purpose-built solution, but it's evolved a lot. So, whereas historically it might have just covered life and disability or something, now there's a full range of coverages and options, and it's a great solution. it coexists with a lot of other insurance offerings, you know, individual life insurance and other things. But we often say, like in our team, the best insurance is the one you buy. So it's really important that, you know, when consumers embark on, you know, take on debt or risk, that they have a solution. I mean, but there's a plethora of other options out there too that coexist with Creditor.
So, you know, we're talking about Canadians, we're talking about consumers. As a customer strategy guy at heart, you know, I always remind myself that we can't paint broad brushstrokes when we're thinking about who the users are of different kinds of products. Curious if you two have a perspective on the types of Canadians from a demographic perspective, from an affluence perspective, in terms of where they work or where they live. Like, who tends to be the most likely folks who are looking at and ultimately buying Creditor insurance?
I'll let you start on that one.
You know, it can be pretty broad-based. So, you know, and it really depends on the lending instrument. So, you know, there's a lot of different creditor solutions serving all kinds of borrowing needs. So I would say, you know, we kind of have the privilege in we have a fairly large creditor business. We have close to 200 financial institutions and specialty lenders that we run bespoke programs. And, you know, some of them, you know, can be a very mainstream consumer that's buying, you know, a creditor solution, you know, with respect to a mortgage. In other cases, it might be very bespoke, you know, a particular, like, you know, and you do see a lot of different behavior with different demographics. So, you know, creditors often priced based on the age of the purchaser. So, you know, it might be a little bit cheaper when they're younger. It gets a little bit more expensive for certain coverages like life as they get older. So, you know, we see a bit of differences there in what people purchase, but overall, it's a pretty mainstream solution that many consumers buy, and in some cases, it can be, you know, upwards of, you know, 30 to 50% of people that onboard for a particular loan might be taking the coverage. So it's pretty mainstream.
I think what we see is a lot of younger people taking on their first mortgage. Definitely that market is great for credit insurance, and because they're inquiring about it. But where we see trending is if somebody in their family had it, they're likely to get it. Or if somebody in their family understands the value of it or has had an experience with it, they are more likely to get it. So in terms of the demographic, it's a little hard to nail, but in terms of some of the other factors around creditor insurance and who tends to get it, that's usually the profile. So I'd say that's where we typically see the customer uptake.
Actually, curious, maybe just do a quick straw poll. Obviously, this room is not a representative sample size. You all know something about creditor insurance, or you probably wouldn't be hanging out with us today. But if you think back to younger versions of yourselves as you were first beginning to load up with debt in the great Canadian tradition, like, how many of you were actually exposed to creditor insurance as you were getting your first mortgage, running up your first credit card bills?
Oh, wow, yeah.
So about half the room.
50%, yeah.
You know, I would say, and Vaishali, you made an interesting comment around, you know, how people think about this when they get their first mortgage. Mm-hmm. Zack, you talked about complementary products. You know, I will say, when I got my first mortgage, you know, my uncle, who's a real estate agent, said to me, Dan, don't get mortgage insurance, get a really good life insurance policy, work forever, die fast.
Yeah.
Like, thanks, Uncle Dave. That's a real dark thought. But how do you and your teams talk to people and build awareness around creditor insurance and how it complements other insurance products?
Yeah, so I think the key in what you just said is that conversation. So for us with our members, we really have to understand what they have for other insurance products and their lifestyle. So reasonably, you know, somebody who is double income, kids, they might want both the creditor insurance because they know that's going to pay down the mortgage, but they're also going to want additional life insurance for life. Because while the mortgage gets paid down, you know, your kid still wants to do, like mine, rep volleyball, which will come out of then my spouse's pocket, groceries, house cleaning, all those things that a single parent gets left with that the creditor insurance doesn't necessarily take care of. It takes care of the mortgage, which is a huge chunk, but not everything. So it's really about understanding how the creditor insurance fits into the lifestyle that this person has and will want to leave for their family. So it's conversational, I think. It's not one size fits all.
You know, I mean, there's so many different ways to potentially answer this question, but you know, there's just like I kind of want to tag in on what Vaishali had said, which is basically often it takes maybe the courage of the frontline advisor to have the conversation, and sometimes they're a bit on the younger side, and they don't necessarily have personal life lived experience of people that have benefited from the product. I guess, you know, I've run a couple of different creditor insurance companies and businesses, and so I've seen just a tremendous number of stories hit my desk of the impact the program has had, so that, you know, it really drives the purpose. And you know, I think that's really important. Obviously, and I think we're probably going to talk about this a little bit, this industry is evolving. We're getting into a lot more digital experiences. So different things are needed in that context, but, you know, still a lot of it is done in a face-to-face way. And so having a really properly educated frontline advisor or lender with the conviction and the courage to have what's often a very uncomfortable conversation.
Yeah,
So
nobody
that's
wants to
super
pay
important.
more when they're already getting a mortgage. That's what it comes down to. Yeah.
Perhaps another question for Chief Engineer. Zack had mentioned pricing based on age. My impression is creditor insurance is a very blunt instrument where sort of everyone pays the same rate. So if everyone in this room had the Meridian credit card, we pay the same rate. Have you seen, is that assumption correct, or is there any underwriting when it comes to the product?
So just before you answer, to play back the question for the rest of the crowd, because I was having trouble hearing during the AI panel, the question was around pricing for creditor insurance. Is it a relatively blunt instrument where it's a one-size-fits-all price, or are considerations around age, demographics, income taken into account from a pricing perspective?
Yeah, so great question.
Yeah.
I think there's an evolution to more flexibility in these programs. So there's a lot more, there's different coverages. There's still quite a bit of underwriting that gets done. But I think ourselves and a number of other insurers, we've kind of raised some of those thresholds to make it easier to purchase the product and know that you've got coverage in place. So what you're seeing as an industry trend is maybe a little bit less underwriting on smaller credit instruments to make it a quicker, simpler buying experience. But certainly on mortgages, most insurers would still provide distinct underwriting.
Yeah, so it depends on the mortgage amount, and honestly, it does depend on age. So you will find that there's going to be some criteria that will make the pricing different, and we do require, in some cases, somebody goes through a medical and all that kind of stuff prior to getting the creditor insurance. And then there's the add-ons. You might just do the life insurance, but if you want critical illness, disability, those are kind of supplementary. Those get added on, and then the price would change based on that. Does that answer your question? Yeah. I do like that you said Meridian credit card, though. I did hear that, so thank you for that.
And maybe just to probe on that further, and I know we've got a number of risk folks in the audience today. You know, given that creditor insurance is such a complementary product, how much do you find yourselves working with your chief risk officers, with your underwriting teams, helping them think about their decisions on whether to lend and how to price the lending in alignment with whether a consumer is taking on creditor insurance or other insurance products?
So I can take that. So historically, there was a small factor in terms of if you had creditor insurance, it de-risked the file slightly. So as we know, we price for risk, so then you could price differently. However, I would say I'm going to lean on the presentation that was in here before with AI. We're actually building models now to track and see what was the probability of default, what was the likelihood of these things, and does creditor insurance factor in as one of those factors to be able to price differently. So there was something years ago, not used as much now, but now we're kind of getting back into the AI space of decisioning and pricing based on that.
Fantastic. You know, I'm at the risk of stating the obvious. Creditor insurance, there's a huge synergy with the underlying lending, right? So, like if you really step back and think about it, you know, to the extent that, you know, some of your customers purchase Creditor, they're actually paying for some of your credit risk. Like, you know, as an industry, it's an incredible synergy. And so, you know, with the sort of 200 programs we have with financial institutions and specialty lenders, a lot of them are doing some amazing things to unlock that synergy. So we have examples across the country where some of our financial institution partners are offering a discounted rate on certain lending instruments when somebody optionally takes the insurance. Of course, it reverts back if they cancel the insurance. You know, the rate often reverts back. So that's just one example. Those are very successful programs. And then to Vaishali's point, there's a big synergy. Like, so if you think about credit risk modeling under IFRS 9, you know, you're holding capital for certain default risks. And if a portion of your customers have bought creditor insurance, there are certain life events that they won't have to default because insurance will cover it. So there's a synergy to unlock there, and a number of financial institutions like Meridian are doing some great work there. So, so those are just two very concrete examples, and that can really help many of you in the room increase your lending capacity. So to the extent that you can unlock that synergy.
So I'm going to pivot the conversation to how credit insurance products are sold. But before I do that, I was going to see if we had any questions from the crowd, and I just saw 2 hands pop up. Maybe the gentleman in the front here?
Yeah, thanks. So my question is regarding creditor insurance for cars. On relevance of it in the state of play today. The reason I asked that is I used to run a card book a few years ago where the bank decided to stop marketing creditor insurance due to code of conduct concerns and the lack of claims that they were seeing. So I wanted to understand the state of the market today, what you see today.
So the question is just around credit insurance and its linkage to credit cards and to payments.
To credit cards specifically, or okay? Actually, it's interesting because that's a very big segment within the creditor space, and it was growing up until the pandemic. I think it was probably even more impacted by the fact that people didn't have a lot of places to spend with their credit cards other than maybe digitally on Amazon during the pandemic period, and they were flush with cash. So balances came down, so the premiums of creditor in the credit card space came down a bit. But a lot of retooling occurred. Products are a lot more robust to address some of the regulatory challenges in the space. And now we're seeing a big upswing as people are spending. You can see that we actually, one of the panelists was going to be Rasha. Unfortunately, she was unable to make it today, but she leads Brim. I see a couple members of the Brim team in the audience. Fantastic growth in credit cards as a service. Like, there's a lot of expansion occurring in that segment of the market, and you know, balance protection or the creditor programs that are offered alongside or adjacent to credit cards are a very key part of the business model for many credit card issuers. So, I would say there's a bit of a renaissance occurring in that segment of the creditor space today.
Nothing to add.
Nope.
Nothing to add.
I think we saw, yeah, another question.
There's a company called Happy Money in the U.S. It's kind of a consumer lending brand that aggregates credit union funds for sort of $10,000 loans. They've added an embedded creditor insurance to every one of their loans. So they're relying on it as a differentiator, customer acquisition. You feel more protected than the alternative lending sources, and also a reduction in delinquency and default mechanism. Do you see that model coming to Canada? If so, how? If not, why not?
You know, we could get into a very deep discussion about the U.S. market with respect to creditor. Very different structurally. Creditor insurance had become something called debt protection in the US, and it kind of disappeared as a kind of individually sold product by major financial institutions. There's a lot of regulatory history there. There's no real reason why it couldn't occur in Canada.
Yeah.
There are a lot of embedded insurance solutions. Like we actually, in Cooperators, we have a very large business in that area, a joint venture with Allianz for embedded travel coverages and other things that go on credit cards. You know, like for banks like BMO, we provide the embedded insurance. So, you know, you could write Creditor as a coverage there. It's an authorized product. So, but, you know, I think, you know, we haven't really seen that materialize. So if, you know, if there's any entrepreneurs here, like, it may be a good angle.
No, I absolutely think, and especially when we think about our newcomers to Canada, where they don't have established credit, you know, wouldn't it be great to offer a credit card that had that already in there? It de-risks the bank again, or the financial institution, and gives a credit card so they can start establishing their credit. So absolutely. So yes, if somebody wants to do that, maybe we will, but great idea.
All right, new opportunities emerging. Everybody here is now in the tent on that. We're all shareholders in the new business. We'll negotiate an agreement after. Let me ask about how creditor insurance is sold. And, you know, Zack, you alluded earlier to the notion that it has historically been a human-driven, advice-centric conversation. You know, as part of my day job, and Vaishali, I'm sure this will be relevant to you, we spent a lot of time talking with the banks and the credit unions on how they're seeking to find a balance between driving transactional conversations digitally, where you can service it more efficiently and more easily for customers, but also maintaining your network of advisors who can help people think through some of the bigger, thornier decisions in their life, and that usually falls around financial planning and credit. What's your view on the evolving balance of, say, traditional in-person channels versus emerging digital channels to help educate and deliver creditor insurance products to Canadians?
So it's everything, right? We need to have information available in every channel, human channel, digital channel, every channel. But I think with insurance specifically, it's not really a commodity product right now. There's a bit of intricacy with it. Some people still don't understand how it works, which is fairly normal. So the conversation really enables people to understand how it works. Oh, you don't get it after the age of 85, like things like that people don't know, right? And then where it would apply in their life. And to your point, as a result, because you need to have that conversation about their whole life, it's not just, hey, you just need to get this product. That person on the other end is like, but why? Why would I need that? How does that make sense for me and what I need to do with my life or my estate? So you need that conversation to still enable that, but I do believe it could be sold digitally at the same time, just enabled with a conversation. So there is some easier stuff that's slowly becoming more commonplace. Like I think the insurance on credit cards, that's a little easier. People, you know, sign up for a credit card, they can take a check, go, they kind of get it there. But in some of the spaces, like with mortgage insurance and critical illness versus disability, what would be better for me? Like those kind of things actually are enabled by conversation. But I do think you need to have all the information available digitally for people that are going to consume it that way.
You know, I think as many in the industry do, we take a very omni-channel approach. We have a concept called guided omni. So we, in our organization, like you know, you want to provide consumers with the channel of choice. Now, a lot of lending is still done in a face-to-face manner, but there's been a big shift to indirect channels like mortgage brokerages and others. So, and then to increasingly to digital. Because we're multi-line, we have an opportunity, we provide so many different solutions, and I would say some of we're all in on the embedded insurance model in a digital sort of journey, so we're doing a lot of work there, especially on Creditor, but you know, certain products lend themselves, they're a little bit simpler decisions, kind of what you were alluding to, like credit card protection is,
home and
it's
auto,
more
I
of a
think.
binary conversation. So, you know, the take-up is higher, for consumers doing it in a self-directed way digitally, but I think increasingly the appetite and the comfort is there with consumers, but it's great to have it all residing on the same sort of infrastructure, whether it's face-to-face or digital. A common infrastructure makes that you let the consumer, pop out of the digital equation and speak to a live licensed advisor if they need to. So we often facilitate a bit of that cross-channel capability. But I think to have a really good experience, buying experience, you need a lot of things to work right. A very well-trained advisor with the conviction. We talked about that. Real good embedment or integration into the journey, and then a great product offering that caters to lots of customer needs and price tolerance levels. So a lot of flexibility in there to make it work.
Oh, see a question in the back?
Was it somebody at Meridian?
A former Meridian employee.
No, I'm kidding. Yeah, no, all fair. Yeah, so it's a tricky balance, right? Because we want to do what's right for the member. So the challenge we have is you can put it on a scorecard, and that kind of makes the conversation happen. But you also don't want to come from a place where you're seen as the bank that's forcing people to get creditor insurance. So what we do is we kind of look at our metrics in the background to say, how much of this is actually sold? And then you're kind of comparing to proxies from your past, say, looks like maybe we're not having enough conversations, and then just going back out and people from like Zack's team will come to the banks and start like refreshing and doing training just to kind of revive the interest in the conversation. Because it's twofold. It goes out of sight, out of mind. We're not measuring it on a scorecard. But there's also an element of, when you think about who's working in the branches, and I don't know who serviced you, but, kids coming out of university and that's their first job, they don't know the relevance of creditor insurance or why that's important. So sometimes they themselves don't understand it, so it's easier not to sell, because I really don't get it, right? So I'd say we use other ways to measure so that it doesn't feel like the member felt like they had to get it. There's no pressure to sell. It was the right conversation, if they had the conversation.
Actually, question from you and then one from me.
So I've worked with lenders where, and sorry, the question was, are we doing anything post-purchase to make sure that it got offered? Because in this case, the gentleman didn't get it offered at the time. So I have worked with lenders where, yes, that's what would happen. Is if it didn't go at the point of sale, then it would come afterwards in terms of somebody would give a follow-up call saying, hey, did somebody talk to you about this product? Are you interested in it? Just to be sure that happened. And I've also worked with lenders where it doesn't. So I'd say it's 50-50. Good idea, though, but yeah, not everyone does that.
Building on these questions, and Vaishali, your answers around sort of human-centric advice, we've alluded to embedded insurance a number of times in this conversation. And as embedded has grown, I think we're seeing scenarios where it's not even the financial institution who the customer sees as the provider of the product, right? You're not delivering the message. It's a retailer. It's a travel provider. It's a realtor or a broker. How are you managing to balance the amazing access that embedded insurance creates with the challenge of having a downstream third party be the one who, in theory, needs to educate the customer on the importance of creditor insurance?
You want to start? You seem excited.
I mean, I think like we're doing so much work in the area, in that area. So we're obviously very invested in making our programs and our products more embeddable. Actually, we have a number of members of our team here that are really focused on that, and we're increasing our investment in that area. So integrating with fintechs like Brim and others to really enable a more seamless experience. And it does come with a lot of other things that have to be wrapped around the process. Obviously, insurance is highly regulated. There's got to be compliance. There's a lot of disclosures and things like that. And you know, it takes some members of our team are kind of nodding because it's way more complex than it looks to people outside the insurance space. But a seamless, integrated, embedded experience is really reflects the way consumer behavior is changing, how people are acquiring loans. It's much more of a platform model, and there's a lot of fantastic ecosystems out there that can really benefit from the addition of insurance to their business models. So we're super bullish on that trend. And we're doing it, by the way, not just in Creditor, but across all of our product lines. Home and auto, travel, group benefits. It's another area. Like we've just acquired a company that does a lot of the platforms, so we can really embed into the employee experience. So it's a, you know, if you listen to, you know, McKinsey or others, like a huge portion of insurance buying will shift into that embedded model, and we're
You
very
mean KPMG? Or
KPMG too. Yeah. So. Sorry, depending, there's so many great reports on that. Vaishali, over to you.
Yeah, I mean, I think the thing is when you're at a bank, you can't sell insurance, right? So you really do need the information to be out there in the ecosystem to be like, hey, this is great. You should really get it. So that's kind of one of the things. In the credit union space, we don't have that because we're not governed by the Bank Act. So we have a little bit more flex in terms of what we can do. So then it's incumbent upon us to really work with our ecosystem of partners to get our brand out there, and our brand would be also offering this insurance product, right? So we can do that. So it's a little bit of kind of doing the things we already do with our COIs to be able to get out there and put the word out there.
So I know we're coming up on time. Before I close, any final questions from the audience?
Yes, so one bugaboo of this space has always been usage, right?
Mm-hmm.
Just trying to ensure that usage is balanced with the offer of the actual product. So just curious if, you know, amongst kind of both the offer, the insurance manufacturer side and distribution side, if you guys have any thoughts on how to balance usage with, you know, of course, the economics that go behind it.
It's a really great question. You know, I think one of the things from an insurer perspective, and then I'd love to hear Vaishali's perspective on this, but you know, we have to be kind of broad-based because there's a concept in the insurance world of anti-selection risk. So if the product is only narrowly offered, it ends up attracting people that probably have higher risk profiles, and the economic model gets challenging. You know, claims can overwhelm the revenue that comes with the product. So you really have to get a kind of broad cross-section of customers to adopt it to make the insurance economic model work. The bigger the spread of risk, the better the solutions work. You know, because they really protect people for very unusual events. But so usage is a critical part of most of the programs that we offer. But
yeah, it's and I've worked for a lender where the reserves were, let's say, not enough at one point, where there was a lot more usage or claims done than was expected. We just really rely on our insurance partners to be really crisp with their actuarial calculations of claims risk, and being, to your point, being very diversified. If it's too narrow, if it's in a certain age category, in a certain geography, you're setting yourself up for risk. So we absolutely need to diversify when we're selling this product, which helps us hedge that risk. Exactly. Did that answer the question?
Yeah, I think it was also just along the fact that you guys were talking about customer journeys and just try to how to ensure that it's easily accessible. That's kind of where I was aiming.
Yeah, okay.
Well, that's a whole. I think, you know, somebody else in the audience asked about post-sale follow-up. There's really so many touch points along the journey that you can offer these programs. So obviously, at onboarding is kind of the magic moment when somebody's opening a new loan. But you know, credit limit increases, very effective.
Even at renewal, if there's no credit, like there's multiple
yeah.
points where you should be having the conversation just to be sure. Like if you weren't interested in last year, how about this year, right?
You know, one of the things we're doing a lot of is integration into things like digital banking, so that there's broader awareness of the availability of the coverage or the lack of availability or lack of enablement of the coverage, like right in people's digital banking experiences, or or on platforms like Cameron is with Brim, and I know you guys have a lot of different customer journeys that it can be embedded into, and I think that's really that's a great driver of enablement.
Question for you about the claims process. So today, for credit cards, when someone makes a claim or wants to make a claim, it's very manual, paper-based. You have to get signatures, and it's quite onerous. What's your thought on like digital claims in the future and evolution?
Yeah. So by digital, it's not just the purchasing experience that's going digital. It's the post-sale servicing and claims. In our organization, somewhere in this room, we have our head of the creditor business, Sarah, and her team has done a great job building a digital claims experience for creditor. It's not trivial, but it's a game changer because we actually, as an insurer, we really want to make sure it's very easy for people to get the value from the product. So, if it's manual, you're limited to certain hours of operation and stuff. And so, going digital on the claim journey can be a real game changer. It gives people the ability to do it in the comfort of their own home and upload their whatever supporting documentation they need. So we're super excited about that. Creates operational efficiency too. So that's actually something we didn't talk about. That's also a big trend in the industry.
Maybe one last question. I see a hand over here.
Yeah, so the usury cap is changing to 35% January 1st.
Yeah.
The current consultations are now looking at embedding insurance in that cap.
Yeah.
Because arguably the predatory insurance is worse than the predatory loans themselves. So how do you see this impacting the landscape? Could it be an embedded product like was mentioned earlier, or where do you see this taking the industry?
Oh man, of course I get the hard question. Okay. I think it kind of goes back to the question that a gentleman had posed earlier. I think the onus is on lenders to be very careful in terms of what they're measuring, because what gets measured gets done. And the predatory practices of insurance that you're saying, because I think there was a big case in the US that was actually there as well. We have to be more careful with what we're asking and how we're asking our frontline teams to do it. So I think for lenders that are already doing that, it's not going to be a challenge because we're not falling into those. But I know you're talking about usury tax, and 35% is what I heard, and that's where I'm going to ask Zack to step in.
Sure. So, generally speaking, obviously there's lots of motivations for regulatory intervention, but it has unforeseen consequences. And it can deprive, I think we heard it from the main stage at the opening address, can deprive segments of the market of access to credit. And especially classifying insurance premiums as part of that equation is doubly alarming because it might put a damper on some of those consumers really need this kind of coverage more than others. So I think it's a bit of a worrying trend, but obviously anything like that can be solved, with tailoring products to address it. I think I mentioned earlier, like we have situations across the country where some insurers drop the lending rate when somebody takes the insurance, reflecting the fact that it's a less risky loan. So I think maybe we'll see a bit more of that kind of trend to stay within the 35 if that comes to fruition. So thank you.
Maybe a final question from me, just to build on that. As we look to the future, 3 to 5 years from now, what are the major evolutions and innovations that you expect to see in the creditor insurance space, and what can we all look forward to hearing about the next time we're all up on the stage together? Maybe Vaishali, I'll start with you.
Yeah, you got me thinking about that. In 3 to 5 years, I think just with moving to digital, I think exactly that claim space is going to become digital. We already see that with your group benefits. You can pretty much you can just tap it in and say, hey, I went and saw a massage therapist and pays like this, right? So there's going to be places for that with life, critical illness, and disability where it's going to be streamlined because it is going to take about 3 to 5 years of work digitally to get there. So I think that'll be the big change. Even though it's not a big change, that will be the big change.
I would say, whereas historically Creditor was a more binary product, just life, just disability, you didn't have a lot of optionality. You had to buy coverage on the entire credit instrument. I think digital enables, the evolution to digital enables a lot more of a bespoke experience, where you can, plus product rules were a bit more rigid. You might have had to buy life to be able to get access to disability. What we're doing and what we're seeing a lot of change in the industry is a more open product architecture, so that and maybe some digital illustration tools to help the consumer pick what they need. Maybe they don't want to spend a certain amount, so they can buy a partial coverage. But the good thing is that caters to more needs and price tolerances. More people buy it, and if a life event occurs, they still have a much better experience than they would if they didn't have the program. So that's one big trend. We talked about embedded insurance. I won't go into that. A lot of platform-based models, I think, are how insurance will be sold. And then last thing I would say is data, and the prior session on AI. I think there's tremendous potential to really adapt the programs and the configurations of solutions in a more data-driven way. And I think AI opens the door to getting even more creative there. So we're pretty excited about it. We've been investing heavily in that area.
I think with that, we'll bring the session to the close. Thanks to Zack and Vaishali for joining me on stage. Thanks to CLA for putting this on. And most importantly, thank you for taking the time to join us. A small but mighty group of folks who really geek out on creditor insurance. And I think we'll be happy to hang out for a few minutes and continue the conversation if folks want to chat.
Thank you.